Hi, this is Gary Ralston. I want to provide a little insight and update on one of the headlines that you've seen. Take a look at this headline from CoStar. Nearly half the $4.7 trillion property debt market matures by 2026. We're looking at $929 billion in loans to mature this year and $1 trillion to come over the next 2 years. So you think, what does that mean for those of us in commercial real estate? Well, let's take a look at the numbers for a moment, if we may. Let's say that somebody did a loan 5 years ago in 2019. They bought a property for $5 million with a 6.5 cap rate. That means it has a $325,000 net operating income. At an 80% loan to value, that would be a $4 million loan. If we look at the loan underwriting, assume 25-year amortization, an interest rate of 4.5%, and then of course the present value would be that loan, $4 million. The payments are $22,233 a month, or annually $266,800. So then if we look at the net operating income less the annual debt service, we show a cash flow of $58,200. That's a 1.22 debt coverage ratio. Let's now take a look at what it is today. That loan matures. Look at the 2024. Let's say the NOI did go up by 5%. That would make it $341,250. And then the balance on the loan, because we've had 5 years of amortization, wouldn't be $4 million anymore. It would be $3,514,316. For the new underwriting, the lender says, well, it's a 25-year loan. We're 5 years into it, so you've got 20 years left. So they would look to re-amortize over 20 years. So if we pick 20 years and today's interest rate is going to be 6.5%, we put in the loan balance and the payment, and then we look at the same kind of waterfall. The NOI of $341,240. The annual debt service now is $314,422. So there's $26,828 cash flow. That's a 1.09 debt coverage ratio, which is unacceptable for the lender. The lender wants at least a 1.2 debt coverage ratio. So let's reverse engineer and see what that looks like. A 1.2 debt coverage ratio would result in a annual debt service of $284,375. The loan balance minus the available loan means that under this scenario, the borrower is going to be $335,833 short. This is what you call cash-in refinancing. So what's the borrower going to do? We think a lot of these properties are going to be sold. They'll be on the market. Interesting opportunities. Thank you.